I think, the all-time high of 54 to 5,500 this year that we achieved will be achieved again within 12 months. So that would imply an 800 point move, right, in gold price. It's the war. I mean, look at the price action. It's telling you that the sell-off was generated March 3rd, which was a Tuesday, by just a lot of margin calls, and people are too leveraged out there. So that's what we call an unwinding of that type of position. There's going to be a lot of uncertainty in a Trump presidency, and that is something that gold and silver love. They love uncertainty and they love fear. For a developer, I really like BlackRock Silver, which is in the US. What's interesting about BlackRock is twofold. One is they're on private land in Nevada, which is really positive in terms of permitting and in terms of quickness of permitting. Number two, they're the only US silver project, according to Andrew, the CEO, that is in this sweet spot where Trump is leading the country and he is fast tracking projects in the US, right? Silver is over 120 million ounces of silver. So silver equivalent, that is.
And I think where we should start is with gold. We're catching up on our last conversation all the way back at the beginning of March. So things are looking a little bit different than they were at that time. We've seen the gold price take a hit since the Iran war began. Of course, still historically high. But I wonder if you can walk me through your reaction to gold's price activity. Has this been surprising for you? How are you seeing it?
Yeah. I'll just say this to your investors. I've been on your show for like 4 years now, so a lot of people have seen my work, and we're always telling it like it is, whether you like to hear it or not. We're not one of those fluff groups that wants to just tell you what you want to hear. This is tough, right? The war situation, if you look at the charts since March 2nd, which was the last time you and I interviewed, that was the high, right? Now it's been 7 weeks of pain. Has that been something that you did, that I did, that investors did? No, it's the war. I mean, look at the price action. It's telling you that the sell-off was generated March 3rd, which was a Tuesday, by just a lot of margin calls, and people are too leveraged out there. So that's what we call an unwinding of that type of position, Charlotte, where people need to sell because they're losing money in other parts of the market and they need to cover those positions, right? So I think that's what predicated the sell-off March 3rd, and it hasn't stopped really.
Gold weakness often reveals more about investor stress than it does about gold itself. As John Feneck points out here, the 7-week decline appears less like a collapse in conviction and more like forced liquidation from over-leveraged positions across the wider market. When margin pressure hits, investors usually sell what still holds profit first, and gold often becomes that source of liquidity. The March 3rd reversal matters because it marked a shift from steady accumulation into mechanical selling. For long-term investors, that distinction can change how risk is interpreted. Next, John Feneck discusses why geopolitical fear can still become fuel for the next move higher.
I mean, we've seen some leveling off, and we did base when Trump said, hey, we're going to do this 2-week ceasefire, right? If you look at the price action when that night happened on a Tuesday as well, things started to really level off and move up, right? But now we're kind of in this period as we record this of, the Vance meeting didn't go off as planned in Pakistan, so that got, prolonged. The Strait of Hormuz is a mess. There's constant news flow there that's not necessarily positive if you think you're getting out of this war tomorrow, right? Like, things are going to take longer than people want. Hopefully, we see a resolution here in April, May, June, and we just move on from it, right? Because I don't think that Trump wants to be, in the press with this for months and months. I really don't. But as you know, I called that Russian war for, lasting for many years, is the way I put it, 4 years ago, and it still isn't over. And that has had profound effects, on the global economy, right? In terms of how people perceive Putin and Russia in general, right? So I'm hoping as an American, we aren't going to get ourselves into a situation where this is going to be years and years of fighting, right? I think we can resolve this. And I hope that would be the decision forward. And that would be very, very bullish for our sector.
Markets can price optimism in a single night, but they rarely price prolonged conflict honestly. As John Feneck points out here, the temporary stabilization after ceasefire headlines showed how sensitive gold remains to political language rather than confirmed resolution. Investors should notice that each failed diplomatic meeting keeps uncertainty elevated, even when financial media treats it like background noise. The longer shipping routes and regional tensions stay unstable into May or June, the more capital quietly moves toward defensive assets. That is usually how sentiment shifts before headlines catch up. Next, John Feneck unravels why patience may matter more than prediction here.
So I just would tell investors, hang in there. You have to fact check yourself, take the weekends, and spend a few hours going through your holdings, doing homework on, hey, has this thesis changed with this stock, right? Like what's happened from March 3rd to now? Not much probably with that stock, right? It's just getting tossed around because of the volatility. However, every person's different. Every person's risk tolerance is different. Some of these stocks have gone, down 50% in 7 weeks. It's not like laughable. It's really serious for the average investor. That's serious money being lost, right? So you have to look at that and say, I need to align with a professional like myself or Don Durrett, my partner, or someone else that can guide you through periods of time like this. You don't need people like us in December, January, February when things are rocking and rolling, right? Like you need people like us now that can help you, that have done this for a couple of decades each. Don and I got started, I got started in commodities in the year 2000, 26 years ago. I started in the business 34 years ago, right? Don's been doing it 25 years. You want people like that can help guide you through difficult times like this. Neither of our services require people to sign up for a year or anything weird like that. So they can come for a few months and leave if that helps.
The hardest losses usually come when investors confuse volatility with a broken thesis. As John Feneck points out here, a stock falling 40 to 50% in 7 weeks can feel personal even when the underlying business has barely changed. That is where emotional decisions often destroy more capital than the original decline itself. Serious investors need to separate price movement from business reality, especially when broad market liquidity is driving indiscriminate selling. Calm review matters more than panic because weak hands often exit right before conditions normalize. Next, John Feneck talks about where discipline becomes more valuable than confidence.
Well, and just a side note, I had Don on, I believe, last week. So there's a recent interview with Don here that people can check out if they would like to. Just taking a little bit more of a look at what's going on with gold. So do you have an idea of where we have support and resistance for the price right now, or is it really too tricky to say at this time?
Yeah, sure. So we got into the 4100s on that decline in March, but it was really quick and short-lived. The price of gold just went right back, to this range where we're at now, and having trouble with 4,800 a bit. But 5,000 is that big round number in the sand. I think that's very attainable. We're trading at 4,700 right now as we record this. I think the all-time high of 54 to 5,500 this year that we achieved will be achieved again within 12 months. So that would imply an 800-point move, right, in gold price. That's going to mean very good things for gold stocks, which we can talk about in a minute.
Right, right. And the trigger for gold to perhaps move higher at this point is that we just get out of this war uncertainty and have that come to a close, and that maybe starts to send gold higher?
That would definitely help to, see gold's rebound off of the March lows.
Round numbers often shape sentiment long before they change fundamentals. As John Feneck points out here, gold reclaiming the 4,700 range after briefly touching 4,100 suggests buyers are still defending weakness instead of abandoning the trade. The real psychological test is not 4,800 but the 5,000 level, because institutions often react to major thresholds more than retail investors realize. If geopolitical pressure fades and liquidity stays supportive, that 800-point upside projection could quickly reprice mining shares. Investors should watch price behavior, not just price targets. Next, John Feneck discusses why gold stocks may react faster than bullion itself.
And Trump has demonstrated that he will go after anyone. We've talked about Venezuela. We talked about Cuba. We have just a long list of countries that I didn't have on my watch list, in 2025. So it's there's going to be a lot of uncertainty in a Trump presidency, and that is something that gold and silver love. They love uncertainty and they love fear.
I wonder if we can maybe look over to something a little bit brighter and get your updates on gold and silver stocks that you're watching at the moment. I know you mentioned maybe because of these price declines, they might not be looking so good right now, but the backdrop hasn't really changed. So what are you watching?
Sure, I'll give you a few. So in silver, to start there, I just did a conference call with the CEO of Silverco today, Mark Iranto. Really interesting story there, and Mark strikes me as a really smart leader who's attracting talent around him. If you look at the March press release they had, I think it was March 23rd, they brought on three new executives. One was from the former CEO of Mag Silver, which a lot of investors knew before they got taken out. Another was from Wheaton, WPM, and then another was from Silvercrest, which has also been taken out by Core. So three really big, names coming on to bolster the team there.
Political instability often creates the kind of fear that precious metals quietly thrive on. As John Feneck points out here, the larger story is not simply rising gold prices, but how experienced leadership inside smaller miners can signal institutional confidence before the market notices. When a company adds 3 senior executives in 1 month, investors should ask whether smart money sees a longer cycle forming beneath short-term volatility. March 23rd mattered because talent usually moves before capital follows. That can reveal conviction that headlines alone never show. Next, John Feneck discusses why management quality can matter more than temporary price weakness.
Additionally, they have some real interesting things happening in Mexico, where they're going to have 2 major hubs for silver production. And look, I mean, when you look down the road of what are the newer silver producers out there, like the companies that you can get behind, that would be like an Avino or something like that, not super large, but large enough, and will make just hand over fist money at these silver prices. I think Silverco is a really interesting one. So that one is SICOF in the States, SICO in Canada. For a developer, I really like BlackRock Silver, which is in the US. That one is BKRRF in the States and BRC in Canada. I spoke to Andrew after their PEA was announced. So if you look at the March 31st news, right around quarter end, they came out with a PEA. Tough time to come out with a PEA following the kind of war stuff that we've been talking about in this show. And it was very conservative. They used very conservative gold and silver prices, which sort of muted the upside reaction, I think, right? Because people wanted to see them maybe use a higher silver and gold price, which is, look, it doesn't matter. At the end of the day, whatever you're using to model these things, the price is the price. So you have to look at ounces in the ground and what is that company's ability to bring it out of the ground and get to production.
Conservative projections sometimes tell investors more than aggressive forecasts ever could. As John Feneck points out here, using restrained metal prices in a March 31 economic study can make a project look less exciting now, while protecting credibility later if markets stay volatile. Too many miners chase attention with inflated assumptions that collapse under scrutiny once production begins. What matters is not headline enthusiasm, but whether the company can extract profitable ounces under realistic conditions. That distinction can separate speculation from disciplined investing in this sector. Next, John Feneck talks about why production timing may soon matter more than resource size.
What's interesting about BlackRock is twofold. One is they're on private land in Nevada, which is really positive in terms of permitting, right? And in terms of quickness of permitting. Number two, they're the only U.S. silver project, according to Andrew, the CEO, that is in this sweet spot where Trump is leading the country and he is fast tracking projects in the US, right? So this is one of those development stories that has a great shot at being fast tracked. and getting to production faster than people think. So a construction decision we see happening next year. This isn't something you have to wait 5 years for. So we like BlackRock a lot. Just one thing to point out, that report showed about 89 million ounces of silver. Remember that PEAs and some of these reports don't show all of the metal that that company has. It's just one snapshot in time. And now that metal, meaning silver, is over 120 million ounces of silver. So silver equivalent, that is. So just wanted to point that out. Lastly, metallic minerals would be an explorer that we'd look at right now. They're also in the U.S. as well as Canada. That one is MMNGF in the States and MMG in Canada. They have 17 million ounces of silver, roughly, of actual silver. They have a royalty project, on the side, they have royalties, and they have a really nice copper play.
Permitting delays often destroy more mining stories than weak commodity prices do. As John Feneck points out here, private land in Nevada can shorten timelines dramatically at a time when investors are exhausted by projects that remain stuck for years. Moving from 89 million to over 120 million silver equivalent ounces also changes how the market should value future cash flow potential. Yet many investors still focus only on daily price swings instead of regulatory advantages. Sometimes the quiet operational details create the biggest revaluation later. Next, John Feneck discusses where overlooked explorers may still offer asymmetric upside.
And they're not getting credit for a lot of this stuff. They're trading at 19.5 cents US right now. I mean, this thing was at 35 cents on big volume March 2nd. This is what we're saying, right? Here's a great example of a stock that's down 40 or so percent on no bad news, and it's like just wrong place, wrong time, right? A lot of these stocks are getting pushed around. It doesn't mean that Greg isn't doing what he said he's going to do. It means that, a stock like this that doesn't have a lot of, the float is thin sometimes on certain days, you're going to see some downward price action. But they have a relationship with Newmont that people can look up on their website, Metallic Minerals. They have a big support in Newmont, which is, to us, one of the best gold companies out there. So, juniors like this sometimes fly under the radar. It's up to us as value investors to kind of go after them as buys when people don't want them. So we talked silver and energy a little bit. I just wanted to mention one gold stock, please, because since the last time I met with you, I talked about Denarius Metals. I went down right before we saw each other at PDAC. I was in the jungle in an underground mine there. Really cool people down there at Denarius.
A 40% drop without bad news usually says more about market structure than company failure. As John Feneck points out here, thinly traded juniors can become easy victims when liquidity disappears and larger funds rotate out of risk all at once. Falling from 35 cents to 19.5 cents can look alarming, but price alone rarely explains intrinsic value in these names. Strategic investors often watch whether strong partners remain involved because institutional backing can matter more than temporary selling pressure. That is where sentiment can misprice opportunity. Next, John Feneck unravels why site visits can reveal what financial statements cannot.
So that one is DNRSF in the States and DMET in Canada. I'll tell you, they just announced a due diligence trip for next month to Spain, which is their other project. So Colombia is their lead project where I was, and Spain is their backup project that's going into production this year. So I'm going to check that out because I feel like this could be a huge growth stock for gold. They just announced their revenues. They only did 1.7 million in revenues last year, and they did 3.5 million in the first quarter. But that's with a very low tons per day, operation. This is going to ramp up a lot faster than people think because I was on the ground and I can see this is going to go much, much faster than people expect in terms of what's happening in Colombia. But Spain is their growth engine, right? And if you look at their February 19th release, they talked about the Saudis really being interested in their Spanish operations because guess what? Some of these countries that are out there that are pro-US, don't have a relationship with China. They're not getting the metal either. So they have to do things like partner with companies like Denarius. So that press release talked about a joint venture of the terms of which haven't been discussed since then, right? So that's a catalyst. When you see a news release like February 19th, you say, okay, this is really positive, but they don't follow it up the next week with terms. It might take a few months, and right now we're at a few months. So I think in May or June we might see some good news there.
Revenue acceleration can matter more than headline ounces when a miner is entering a growth phase. As John Feneck points out here, moving from $1.7 million last year to $3.5 million in one quarter suggests operating leverage may already be building beneath the surface. Investors often miss that early production stories can re-rate before the broader market sees the numbers stabilize. The February 19th release also hints that strategic foreign interest could reshape valuation faster than analysts currently model. Those catalysts deserve closer attention than most realize.